Thanks, Debbie. Hello, my name is Daniela Lester, and I'll be covering the major strategic alternatives as well as the decision criteria of the JetBlue case. JetBlue's management has several alternatives during the final phase of issuing the IPO. Once, they can issue the IPO to match Southwest Airlines. 2, they could issue the IPO at a higher risk premium. And 3, they could delay the IPO or issue no IPO at all. On slide 6, we'll talk first about issuing the IPO to match Southwest Airlines. Southwest Airlines is JetBlue's biggest competitor, and they've been in the industry since 1967. They also offer low fares, just like JetBlue does. Now, the advantage would be if we match the beta to that of Southwest, that investors perceive the risk to be the same as Southwest Airlines, although JetBlue has not been in the industry as long as Southwest Airlines would have been. Also, the higher price will satisfy the management because we're now in this situation not leaving too much money on the table to offset the IPO flotation costs. Now, on the flip side, there are some drawbacks. The high stock price will possibly lower the demand, and that in turn will also give us a potential loss of external capital. In addition, there could be lawsuits in the future due to a possible inflated value of the company if that had been done on purpose. Please turn to slide number 7. The second alternative we will discuss is for JetBlue to offer the IPO at a higher risk premium. Now, since JetBlue is relatively new to the airline industry, we as a group thought that it would be reasonable to assume a higher risk premium, a higher beta than that of Southwest Airlines. The advantages come from discounting the IPO price. Now, the lower share price will give us a higher demand of shares, and that increased demand will also increase the raised capital, which JetBlue desperately needs in order to finance its growth. Also, that in turn will decrease the risk of any potential lawsuits in the future. On the other hand, this option could actually lead to a loss of potential capital, as investors may seek other options to invest in that have a lower potential risk. Further, the underpricing approach may even aggravate the issue of management already debating covering the flotation costs with the premium price. Please turn to slide number 8. There are numerous advantages for a company going public: the influx of capital, the increased public awareness and liquidity. However, due to the risks and the costs associated with the issue of an IPO, JetBlue may consider to hold off and raise more convertible redeemable stock instead. The advantages of delaying the IPO eliminates the risk of the volatile stock market as well as the flotation costs. Going public and being public comes with a cost. You have to invest in reporting systems, you have to start employee compensation plans, you have to come up with to cover the cost for audit fees, legal fees, and also recruiting a board of directors. So all these costs would be eliminated if JetBlue would not be going public. However, JetBlue is quite far in the issue of the IPO, so in that case it might just be better to hold off and wait for a better market in the future. Since 9/11 just happened, and this market is just not very favorable for any company in the airline industry. Further, when JetBlue goes public, its financials will be available to everyone, including competitors, and those competitors can use that information to their advantage. Also, those preferred stock may be quite attractive to investors since they guarantee dividends as long as the company is in good financial standing. On the other hand, that option might actually come up with a loss of capital raised due to the loss of potential investors. Those preferred stocks, they're cancelable at any time, Plus, they can also not grant shareholders any voting rights, so that might turn off some investors. Please turn to slide 9. Here we're discussing the decision criteria. We're using 4 decision criteria in order to evaluate our alternatives and come up with a recommendation. 1, the forecasted growth rate. 2, beta. 3, terminal value. And finally, external factors. Now, investments in aircraft are needed for JetBlue to meet the growing demand. And the growth rate directly impacts JetBlue's operating profits and the valuation of the firm. The beta measures the company's return relative to the market return. And the beta can change over time and is directly influenced by business risk and financial leverage. If the beta changes, it directly affects the capital asset pricing model. So it affects the weighted average cost of capital, the net present value, and finally the share price. The third decision criteria is terminal value, which is an important part of the valuation process. It assumes that the cash flow continues to grow at the same rate after a period of time. So since the long-term value is highly unknown, the terminal value plays a crucial role in the valuation of the firm. Finally, JetBlue has to deal with several uncontrollable external factors. The timing of the offer, the confidence in the market of investors, terrorist attacks, natural disasters, interest rates, government regulations, even publications from analysts. Should a financial analyst publicize that he believes that the stock is underpriced, the demand will increase. However, if he would publicize that the stock may be overpriced, the demand will decrease. So all those factors, they influenced our analysis and finally our recommendation. I'll hand it over now to Kevin, who's been going over the analysis of the first 2 alternatives. Thank you.